Welcome to Easy Accounting for All. This is the video 404 and we are going to complete the accounting cycle for AMP. We will cover the trial balance, the balance sheet, the income statement or profit and loss. You will learn what each financial statement shows, how to prepare them, and how they are connected. By the end of this video, you will understand the purpose of each report and how to present them. Subscribers can access practice and resources to improve their skills and continue building a strong foundation in accounting. So let's do this. But before that, just to refresh, in video number 3 we're learning about the following topics: how to create chart of account, type of chart of account, we create fictitious business our maintenance and parts AMP. We use a company that provides repairs service with and without parts and also sell parts at retail. We create transaction for the month of August. We start and complete an exercise doing journal entries. There were some accounts clarifications as we moved through the exercise. We applied the accounting accrual and cash method. We clarified the concept of the accounts through the journal entries. It was an opportunity to understand the concept of cost of goods sold. And we clarified the concept of accounting cycle. So let's talk about the trial balance. The trial balance is an internal financial report that displays all account balances by debits and credits. The main purpose is to verify the accuracy of accounts balances. The accounts in this internal report are listed in the same order and listed on the chart of accounts. The trial balance is divided into 3 sections: heading, which includes the business name, title of the report, in this case is trial balance, and the day. And the day, it should say as of, okay, because it's a specific day. The body includes accounts name, debit balance amounts, and credit balance amounts. The food includes the total debits and total credit that always should be equal. That's the trial balance. So let's talk about the income statement or P&L. An income statement is a financial report that shows a company's revenue, cost of sales, and expenses for a specific period of time. So the other one is as of, this is a period of time. It tells how the business performed during the time by showing whether the company made an income, profit, or lost money. This report helps people make decisions about the company's future operations. Net income is the money earned when total revenue is greater than the total cost of sales and expenses. Net loss is the money lost when total revenue is less than the total cost of sales and expenses. So in other words, this is a math equation: net income or net loss equal total revenue minus the addition of total cost plus expenses. So let's continue with the income statement. An income statement or P&L, it has 3 sections as well. A heading report includes the company name, the financial statement name, and the period. Remember, this is a period for which the report is presented. The body, this is the main section containing account names and amounts. This section includes a special account classified as income, revenue, cost of goods sold, and expenses. The foot of this report, it shows the profit or loss for the reporting period. Let's talk about the balance sheet. It is a financial statement that reports assets, liabilities, and owner's equity on a specific date. A balance sheet has 3 sections as well. A heading report includes the company name, the financial statement name, and the date as of. That's important. The other one is period. The balance sheet says as of the report is presented. The body. This is the main section with accounts names and amount. This section it has special accounts classification as current assets, non-current assets, current liabilities, non-current liabilities, owner's equity, and that's it. In our case, we are not going to have non-current liabilities. We are going to have just, we're going to classify as a current assets, non-current assets, but we have just current liabilities. The footer of this report is the total assets and total liabilities and equity. So the balance sheet accounts classifications, we say the current assets. What is the current assets? Are all the resources of business owned that are expected to be used, sold, or converted into cash within the next 12 months or within the company's normal operation cycle. They usually include cash and cash equivalents, accounts receivable, inventory, prepaid expenses, and much more. Non-current assets are resources a business owns that are not expected to be converted in cash or sold in the short term. Instead, they are held for long-term use in generating income and supporting the business operation over several years. They include property, plant, and equipment, long-term investments, intangible assets. So the balance sheet also has 2 ways to present, 2 formats to present the report. One is the T account format. This is the traditional format that presents the balance sheet like a T account with 2 sides. The left side has or present the assets, and the liabilities and equity is presented on the right side. Now we have another one. This is a vertical format. This is the type of report where all the accounts are presented in a single column, starting with assets at the top, followed by liabilities, and then by the equity. Now let's create the trial balance, income statements, and balance sheet for A&P. And again, we are going to create these reports based on the data that we work with for A&P for the month of August. And the full set of journal entries that we use for August is on video number 3. So we are going to use the same ones to start with this. So in order to do that, I'm going to use Excel. So I'm going to move to Excel because it's the way that I'm doing this one. We are not using any accounting software because the goal is for you to understand exactly how the information is generated or is managed by the computer's accounting softwares. Okay, so let's move to Excel. Okay, this is the Excel. I just want to start just to refresh the memory that this is all the journal entries that we did in our video number 3. Right? This is all the transactions that we did. So in order to create a trial balance, we have to calculate the totals for each account that we use here. How much for total? And in order to do that, it's just like put together or consolidate all the numbers that impact each account, either debit or credit activity. To illustrate very quick that one here, this just type of illustration in T accounts, I create this too. Oh, let's see. 1 second. I'm going to find. Yeah, it is something like this is a T account. Remember that we have the name here, debits and credit, and this is for cash. So this is exactly what happened in our activity. So this is one way to present or to calculate those ones. So this is the total debits 50,760 and total credits 50,760. So we don't have any balance here. Same with the banks. But obviously this is a very long process. In computers or even in Excel is easy to do that. So we are not going to go through this one. Either way, I did for all the accounts just to illustrate you guys, but that's not going to happen right now. That we are going to do that because it's going to take too much time. Look at create these ones, all these ones. I'm going to show you. This is all the accounts, right? The T accounts. So I create just for a group for the assets, the liabilities, the owner's equity, revenue, cost of sold, and expenses. It's a very long scenario. But it's one way to explain the T accounts also, how to calculate the balances and the activity. But anyway, in this case, what we're going to do, or I did, I just use one function here in Excel, that is to create a pivot table, and with the pivot table they're going to give you exactly the total amount for each account that we use here. So in order to do that, and after I just use that function, I just obtain the total by account, which is this one. So we say that same way that I show you in my individual T account, we have the account cash has a 50,760 activity in the debits, and the credits the same amount. So we already know by logic and just visually that the balance is going to be zero. So we did it for all these accounts. So that's the first step. So you have your entries, but after that you have to find out what is the total for each account that was involved in the journal entries that we use to record all the transactions. So this is the balances. Now, it is very important always to find out that the totals here matches, which we already did it when we created journal entries, and we went to this one, and it's the same amount. So that means we are okay. Okay, so we had this one, but I say this is part of the way that we start to figure out the trial balance. But in order to do that, we have to find out the balances, because remember the word trial balance, right? Doesn't say trial activity, this is trial balance. So which means we have to find out the balance for each account. So that process I already did it here, right? So what I did, it is just to trial balance. But I want to explain something here. Do you see this part, this column? That's a beginning balance. Well, if we think about this, we had just activity, we started our activities in August, right, of this year, let's put it that way. Our beginning balance was zero. They were totally zero. Okay, no activity before, zero balances, so that's not a problem. But again, when you just, let's say that we have activity in September, our beginning balances is no longer this one. Our beginning balances in respect to September is going to be the ending balance of August. The ending balance of August. Okay? So anyway, here we continue to apply the concept that the assets accounts increase with debits and decrease with credits. So I just create a formula here. Since I have the assets accounts, I have what to say that plus the debit beginning balance minus the credit beginning balance plus the debit activity for the month minus the debit activity for the month equal my new balance. this is my ending balance for August, these columns, right? That is going to be necessary if we got to do the trial balance for September 30. It's going to become our beginning balance for each month. But in this case, it's our ending balance, and we are talking about as of August 31st. But I just want to make sure that you guys understand that to call this concept, the beginning balance. Well, now we have the balances. Technically, these two columns are the ones that conform the trial balance. So what I'm going to do is technically to extract these accounts and these columns, and we have already the trial balance. Let me move to this sheet because I have that report here. So that's here you are, and we have the trial balance as of August 31st. So which includes all the accounts, and this is just to refresh. This is the assets accounts, the liability accounts, the owner's equity accounts, the revenue accounts, and the cost of goods sold account, and the expenses account. Alright? So that's what we say in the definition. Trial balance is the list of all the accounts with the balance. All the accounts for that company with the balances. Balances, debits, or credit. Now, in the computerized systems, they have the option to say if you want this report with or without zero balances. Normally it's with all the balances, but you can just filter that one. I just keep the ones that are without zero balance. But in this case, we have one zero balance here. Okay, so is that okay? That's perfectly right. Okay, so now we have, this is the trial balance. By the way, again, just make sure that we're on balance here. Okay, the amounts just should be equal amounts in both sides. Always check your balances, your total balances here. Because if they are out of balance, you already missed some information, or something is wrong and you have to go back, probably to the original general journal entries. Okie dokie, so now from here we have information to create. If you see, we have here all these accounts that are part of the balance sheet. And also you have here, you can see the accounts that are part of the accounting equation, because assets minus liability, assets equal liabilities plus owner's equity, and we have the assets. And also you have here the revenue and all the accounts that belong to the income statement or profit and loss. I'm going to start doing the profit and loss. And why the profit and loss? First, another balance sheet. Because from the profit and loss, we need some information, very important information, that is going to be reflected in the balance sheet. So let me move to the profit and loss. Here we have the profit and loss. I just copy this here, the one that we have here. I just copy this one to here, just to show you some information. So what we do, it is to present in a specific format. You can customize how you want to present, but this is the standard format to present the profit and loss or income statement. So you have the head here that say revenues, you have the heading here that say out the company name, the type of report is income statement, or the people just call profit and loss, and this is for the period August 1st to August 31st for the year. So now we have a group of revenue accounts that generate money, right? So we have the service revenue and the sales revenue. And we can just add up those one and we can just get the total revenue. So this is our total revenue. After that, we have to reflect the cost of goods sold. So in this case, we have just one category because that's the way that we set up the exercise. It could be more, it could be other type of reports, other type of accounts that you already set out that are direct costs. But in this case, for this exercise, we just put the parts only, not the labor. Anyway, so after that, we just calculate something that is called gross profit. What is the gross profit? The total revenue minus the cost of parts in this case, which that means that we earn, right? We had a profit of 930 in terms of the total labor and parts minus the cost of the parts. Again, we are not talking here about the cost that is like a labor, we just put as expenses every year, but it could be another thing. But anyway, just for exercise purpose, this is what it is. And after that, we list all the expenses. And again, all the information came out from here, from the from the trial balance. So we just list that one here, the expenses. We totalize the expenses. The total expenses right now is 5,148, but at the same time we have a cost that is 630, right? So we have more than that we received during that month. So that's why we have, if we calculate, if we make a profit or we lost money, we just say we can already calculate the gross profit. So we are going to hit this total here is going to be the gross profit because we already deduct the cost of goods sold minus total expenses. Okay, so that's what it is. And based on this exercise, we lost $4,218. Now, I say that I want to do first the profit and loss or income statement because what happened is we need this amount to present it or to transfer into the balance sheet. So let's move to the balance sheet. I hope this is clear for you guys, but let me move to the balance sheet. So the balance sheet also, and let me copy this one here one more time. I just copied this just as a reference, okay? That way is some clarifications about where the amounts coming from. So we have the asset, we have the heading here, which is our maintenance and parts, the company name, balance sheet as of. As of means a certain day only. So this time is as August 31st of the year. So we classify this one, we say that the classification is assets, current assets, and we had as a current asset, we had the bank, account receivables, inventory, and prepaid expenses. It could be any other type of accounts, but in this case, for our exercise purposes, is what it is. So we had the total current assets 35,725, right? And we are going to move to non-current assets. We already went through the definition, what that means. And we have here tools and equipments, 10,500, furniture, 3,500. So total is 14,000, but minus the accumulated depreciation, which we calculate in our exercise 171, which means the total non-current assets is 13,829. So these 13,829 plus that are non-current assets plus the current assets give me the total assets, right? So we have total assets 49,554. So the second part of the report is the liabilities and owner's equity. So let's find out liabilities. I say that we don't have non-current liabilities. Our exercise came just with the current liabilities. But if we had non-current liability, we had to insert in between owner's equity and current liabilities, we had to insert the columns or the rows to present the non-current liabilities. Okay, so we have the current liabilities here, we just processed one, and the current liabilities is equal right now to total liabilities. So we present that one here, and also we have the owner's equity. So we have the owner's equity capital, the original capital investment was 50,000. They removed or they took out $1,000 from there. And here we are with the loss. This came from the P&L. Okay, so we have here, this one here, 4,280, we have to put it here. In that way, we still continue keeping balance because we had the total liabilities and owner's equity, 49,554, and we had total assets, 49,554. So, always those totals should be equal. Okay, no discrepancies at all. Okay, so far look at we already did the financial statements as of August 31st. But now I want just to, if you remember, when we start talking about the accounting cycle, the word was that after financial statement we have something that is called end-year closing entries. So I would like to say that I want to assume, in order to explain that part, that August was the only activity for this company during this year. So these balances for the P&L, especially for the P&L, they are the same as of December 31st. You see that we create the company, but the company just makes some pause and they just close for temporary. They don't have activities in September, October, November, and December. So these amounts are going to be the same balances by December 31st. Okay? So in December 31st, we had to do something that is called end-year closing entries. And the only accounts that we close is the profit and loss accounts. And again, the only assumption that I have here is that the accounting period for this company goes through the calendar year or runs with the calendar year. That means January 1st through December 31st. Okay? So in December 31st, since we don't have any more activity, these are going to be my same balances. So we are going to close these accounts. We never, and I want to repeat, never we do the closing the entries for balance sheet accounts. The balance sheet account is the carry-on balances all the time. Right? Each time that you just close, or in other words, each time that you just create a balance sheet, those balances became the beginning balance for the following months. Is carry on every month. But at the end of the year, they still continue, move forward to the following year. So one more time, we close just the P&L or income statement or the nominal statement accounts. So let's do the exercise here. So if this is our balances as for December 31st, since we don't have any other activity, so we had to do the closing entries. To do the closing entries, you have to do general entries, so like we do here, right? Using this format, or format like this, as an example. So you have to create one by one, right? Okay. So we say that the credit accounts increase with credits and reduce with debit. So in order to reduce 560 that is created, we have to create debit. So we can just get the balance 0. Same way, or same concept, if we had a debits accounts, the debits increase with debit and decrease with credit. So we have to do the credit here and just put it 0. The difference always in these things, it's going to be always the loss that we have, okay? So this is credit. Let me put in this one. If I do the formula here, so these are going to be 0. The addition is going to be 0. So we are closing this one. Now, let's assume that on January 1st of the following year, first thing in the morning, let's say you just decide to not celebrate the new year, you just decide to open your create your P&L on January 1st at 8 a.m. right? So your P&L is going to be 0, okay, because it's not activity. But at the same time, your balance sheet is going to show something different. Not in terms of numbers, it's in terms of the classification of names, account names. And that is going to happen just in this owners equity section. And this is the way that that looks. So the rest of the balance sheet is going to be the same because no activity. It's January 1st at 8 a.m. Nothing happened. So, but the only thing that you're going to see is that each time that you change the year, right? And we say we assume that the company has an accounting period is equal to the calendar year. So on the January 1st of the following year, for this example, that is going to move the profit or loss to one account that is called retained earnings. So since it's January 1st in the morning, 8 a.m., no activities, so your losses or profit is going to be 0. Okay, so as we move, if you have profit, you have this positive, and this one is going to reflect every month what is the profit for that month or for that period. But this is going to just accumulate anything that happened after you close every single year based on the accounting period, which is the calendar year. The last thing that I'm going to mention and recap is about the balance sheet format of presentation, and we already went through one of those, which is this one. This is a vertical form, okay? So basically what they do is just making a form, the assets first, after the assets usually is in the same column, the liabilities and owner's equity, and you get the totals for each group. That's the one that is called vertical, okay? Or we can just probably call portrait. And the other one, landscape. But in accounting, we say the other format is the T format. And we have the T format here. So you see I highlighted just in red color the T just to exalt that concept. So we have in the left side, we have the assets, and the total assets is 49,554. And we have the right side, the liabilities, and the owner's equity with the totals for by groups and the total liabilities and owner's equity or total liabilities plus owner's equity equal 49,000, which is equal to the total assets. And remember, assets equal liabilities plus owner's equity, and that's the accounting equation. So I hope this helped you to understand the full process, the full cycle. It has been a pleasure to transfer this concept to you, to teach this part, and I hope you enjoy these videos. So thank you for taking part of this experience exploring the basics of accounting. I hope the AMP example helps you feel more confident with the accounting cycle. This is just the start. More videos coming soon on inventory, prepaid expenses, assets, payroll, and other accounting concepts. If you found these videos helpful, feel free to share and subscribe for updates. I would love to hear your questions and feedbacks. Check out the next videos, and thank you for everything.